where we will be hosting a panel discussion around Brexit and what that means for finance leaders. In 21 days' time, on the 31st of December, the transition period between the UK and the EU will officially end. A lot of people have forgotten that the founding purpose and the formation of what we now know as the European Union was actually to end the frequent and bloody wars between neighbours. So I think originally it was 1950. It was the European Coal and Steel Community, which began to unite European countries. So there's no question about that. We could have lost sight of the founding principles, I believe. A meeting group like welcome our panel of experts will help distill some of the mystery around Brexit. So I'd like to welcome Adam Johnson. Hi, Adam.
Hi, Jason. You okay?
Good, thanks. Adam is a patron of Made in Yorkshire, and he's also director of Tudor International Trade. Look forward to hearing some of your views. I guess you've been very busy at the moment.
Yeah, very busy at the moment, Jason. Lots of people wanting to know how a deal or no deal is going to impact them. So hopefully we can get stuck into that a little bit later on. Also pleased to welcome Janet Mew, who spoke at the Back in Britain exhibition, and you've become a bit of a celebrity in recent months, haven't you, with regular appearances on Bloomberg, BBC, and other panels. Janice's investment spokesperson for Brew Dolphin. Thank you very much for joining us, really appreciate it. And then we have Jas Baines, who is a currency expert for Rational FX, long-term patron of Made in the Midlands. Thanks very much for joining us, Jas.
Thank you, Jason, and good afternoon, ladies and gentlemen. Hope you are all well, and absolutely kind of looking forward to this panel talk and a debate. Any questions, of course, more than happy to answer.
Jas has become a bit of a futurist because every time I've spoken to Jas in recent months, you seem to have accurately predicted the following week's currency fluctuations. I'll be putting you on the spot.
No, please, by all means. We've got some really, really interesting ideas for importing clients and exporting clients to hopefully before whatever the result's going to be on Sunday, whether it's a deal or no deal. Hopefully there's not an extension, and got a lot of ways to protect clients if the market goes against them, whether it's of course a deal or no deal. So really got some really good ideas to share.
Well, there's a tremendous amount of uncertainty, and I think we've got some existential threats and risks around trade. Obviously, people are concerned about how they will trade, what the relationship with Europe will look like, because we still don't actually know what that deal is, if there's going to be a deal at all. And that just puts us all in a very unusual position. And there's a few bits of research I've been looking at, such as the FTSE market, how we compare against other countries, and what that means for the future of the UK. So perhaps I could start off with, perhaps a simple question. So what do you think the UK will look like after Brexit? I'll start with Janet.
Sorry, I really cannot hear clearly. Do you mind repeating your question? I think my line is very bad.
Yes. What do you think the UK will look like after Brexit?
Sorry, I can't. I need to join from my laptop, which I'm trying to boost. Can you give me some time? I'm really sorry. I really can't hear properly.
No problem.
With my phone. I'm so sorry about it.
Maybe that's one for you, Jas. So we've got demand for UK equities has been suppressed since 2016. In the 10 quarters before Brexit, the UK attracted 300 billion from foreign investment. In the 10 quarters since, this figure is only 40 billion. And how do you think the UK will look like after Brexit? You talked about some interesting concerns that you had around the devaluation of the currency. Perhaps you want to expand on that.
Sorry, Jason, if you can just repeat some of it. I know the line's really crackly. I don't know if everybody's got their kind of buttons on mute whilst you're speaking there. I'm not.
Okay, hang on a second. So, let's just see if Jamie's back on. Hi, Janet, you back on? We just have a few technical issues. How's my sound coming over to you, Jazz? Can you hear me clearly?
That is much better. Yeah, I think there's interference. I think, of course, with having people on mute, not mute. I think that's a lot better now. Maybe we've probably seen it's probably putting their phones on mute for sure. That's a lot better. So if you just rephrase that question again, for sure, please.
Yeah, sure. So the demand for UK equities has been suppressed since 2016. Obviously, the UK's magnet for international investment, but in the 10 quarters before Brexit, the UK attracted only 300 billion pounds worth of foreign investment. In the 10 quarters since, this figure is only 40 billion. And the question is, what do you think the UK will look like after Brexit?
Look, that's a £10 million question. I'm sure, if anybody knows the answer, count me in. I mean, let's just go back before even looking at maybe this Sunday the 13th of December. Hopefully we should have a decision, a deal, no deal. Will there be a further decision? Again, we don't know. But personally, go back to post-referendum in 2016. Look, we all thought the result was going to be in one direction, which of course it wasn't. And normally what happens based on not just economical, but mainly on political events, and I highly emphasize political, whether it's a Brexit deal or a no Brexit deal, we've just gone through the presidential elections of recent, but when there are political events, the following day of the announcement, whether it's a presidential election or on Monday morning, in fact, or should we say Sunday, when this Sunday the 13th at 10 p.m, when the markets open, what you're going to see firstly on the BBC News, whether it's on Bloomberg or any financial channels, Citywire, it's all about the pound. Stock markets, pound, and as we know, what happened on the post referendum, the following day on the news, we saw the pound almost lost under 15%, didn't we? So I think going back on your question there, Jason, it's going to be a very, very interesting topic there. How do I see the pound post whether there's a deal or a no deal? Now, let me actually give you some of the actual my history speaking to chief economists, some of the big bankers out there, some of the big channels like Reuters, FX Street, or Bloomberg, etc., etc. Now, I'm going to break this clearly. We got two divisions. We got an import division, and we got an export. Now, if on Sunday, if there's a no deal, that's going to be, well, it's going to be a no deal is going to obviously on the pound is going to be a big loss, potential big loss anticipated. Now, we've got forecasts where if it's a no deal, the pound potentially could lose anything, probably could be anything between 5 and 10%, range bound. Now, let's go back to 2016 again. We lost 15%, under 15% on that pound, 15%. But how long has Brexit been going on for? How long has it been going on for? Now, the question is, if there's a no deal after the discussion on Sunday, the pound will probably lose anything between 5 and 10%. And who is this going to affect? It's going to heavily affect importers. Obviously, it's going to be great for manufacturers, international trade, because obviously they're going to get more value for their money. But now let's just flip it on the other side. If there's a deal, it's forecasted, and it's not going to have as much movement as there's a no deal, because we are already anticipating that hopefully post Sunday the 13th, whatever the decision is, well, sorry, if there's a deal, that the price, the market, currency market is already priced in, that we're expecting a deal. So we're looking at probably a range band. It could be potentially anything between 2 and 4% appreciation of the pound.
That's interesting, Jazz. In fact, I was reading on Global Expat Guide that in the first half of 2016, the pound was the worst performing currency. And you mentioned it dropped 15%, so that sort of ties in with the what you just mentioned. And I guess we're facing probably stronger challenges today than we was in 2016, because we not only have Brexit, we also have a pandemic.
Absolutely. And just add another string to the bow there, Jason, just another comment. So if we do get this deal that has been anticipated, and I'm sure we should come to a compromisation, if we don't, there's going to be potential, obviously, forecasted, hypothesized disasters for both sides. So I think if there's a deal on the back of this, the currency market won't move as much. It'll move anything between 2 and 4% range band. Again, I'm only kind of going back on forecast figures here. But what does that mean? That'd be great for clients that are importers, if there's a deal, but not so good for clients that are manufacturing part of the international trade.
Brilliant. Cheers, Jazz. Just want to welcome Janet. Good to see you again. I think the sound's off. Let's have a look. We can't hear you. Maybe the microphone. Would it be easier to join by just a computer? Yeah, still can't hear you. Yeah. At least you get to get these technical issues with us rather than Bloomberg. They've probably got a better technical team than us, I'd imagine. How about you, Adam? While we come back to Janet, what do you think the future of the UK will look like after Brexit? How do you think we will cope? What's your predictions?
It's a lot will rely, Jason, on kind of the outcome of the discussions that are taking place now on Sunday. And if a deal is struck, it will make it a lot more straightforward for a lot of businesses that are currently trading between the UK and the EU. The main thing for us that we're trying to make people aware of is that if there is a deal that is struck, it doesn't mean it's just back to how it was before. There's still going to be changes that you need to be thinking about. There'll be customs formalities both at origin and at destination, so between the UK and the EU. And just because we have a deal, it doesn't just go back to how it was previously, with people being able to move over the Channel Tunnel as freely as it was previously. So it will have quite a large impact. Now, if we also bring in the fact that we could have a tariff situation, then that is going to obviously have quite a large impact from a cost perspective. The duty rates, if we fall down to the WTO rules, the best way I've been telling people is that it effectively is the same kind of system that the EU currently has with Australia. So it's quite straightforward for us to be able to work out what the duty rates would be payable on items if we fall out of having a deal. And these duty rates, they're anything from duty free up to 40% in some cases. So there's quite a large cost that people need to be considering, and it's very difficult for businesses at the moment to plan ahead for that section, because somebody's going to have to bear this additional cost, the customs duty on some of the more expensive items. It's going to have a huge impact on margins, which might already be quite small. So again, it's a lot is going to be reliant on the outcome of this week. But then again, we haven't really got a lot of time to prepare either way. So it's going to be challenging, and certainly from our perspective, with goods moving between the UK and the EU, the first few weeks, I'm sure there'll be teething problems, but that will straighten itself out in time. The main thing that that businesses really need to be aware of, Jason, is that there is extra paperwork that needs to be completed. If you've already dealt previously with further afield, probably the businesses will already have a good idea as to what's required. But effectively, a movement between England and France would be treated no differently between England and China or England and the States. So it really will have quite a large impact for businesses that purely deal with the EU and the EU alone.
Hello, can you hear me?
Thanks, Adam.
Hello.
Oh, yes,
Hello?
Janet.
Can you hear me?
Yes.
Okay, thank you so much. Sorry about that. I think the settings was wrong.
Yeah, I think there's some sort of
yeah, huge apologies.
Something that blocks the website.
Some firewall. Yeah.
Thanks for persisting. And same question to you, really, Janet. So, what do you think the UK will look like after Brexit? And perhaps just with the extra caveat, I was reading on City AM that the FTSE is underperforming in comparison to its European peers and also the American markets. What do investors hope for, and what are the challenges? What do the UK could look like after Brexit?
Yes, I think the financial markets, they are really hopeful of a deal. From what the pound has done over the past couple of months, we think that there is really quite high optimism. Even with the recent weeks where there are some negative headlines which says there are still huge gaps and the deadline approaching, and there's definitely increased nervousness. I think the pound is still relatively resilient, and the volatility is really not at very extreme levels. So I would say that if we have no deal, I think the markets will be very disappointed, and I think there is a lot of room for pound to fall in that case. So I think if there is a deal, I think sterling would rise, but the scope of that increase in sterling is probably less than the potential for a downfall if we have a no deal.
Brilliant, thanks. And one of the conversations I had with Jazz before this meeting was about the devaluation of the pound, which is obviously a worst case scenario. Are there any upsides to that? Perhaps, Adam, would we be more competitive as an exporter, or would that be negated by the fact that the imports would be priced higher?
It really just depends on kind of whether you're an importer or an exporter and who you mainly complete your trade with. So one thing that if we do have no deal and you're importing goods or moving things from Europe, for example, you're going to get stung with a large duty percentage now on your goods. You might find that actually you can find those goods or manufacture them or source them from somewhere else in the rest of the world, Far East or America, or even in the UK for a very similar cost. So it's going to be quite interesting to see how that develops, to see if that extra increase in the cost of importing, if there is no deal, does lead to some people looking to different suppliers perhaps for their goods, for their raw materials.
And just one more question to you again, Adam. So really logistics and mainly at the ports, I guess, which is, if this ends up being quite bad for the country, is there a risk of perhaps big shipping containers perhaps calling, or shipping companies calling on the UK less frequently? And how would we mitigate that risk? Would we need to invest in ports, or what's the threat there?
Possibly, although having said that, Felixstowe is probably in the top 5 ports for kind of the cargo going through it in the whole of Europe. So a lot will stop there on the way through, and even if it's going across to Ireland, it's still seen as kind of a huge hub. You've probably seen on the news recently the amount of congestion that's been caused by PPE coming in, and also people trying to bring goods into the UK prior to the year end. We're seeing some huge backlogs, and that's not just at Felixstowe, the main kind of port here in the UK, but also Southampton, London Gateway, Grangemouth up in Scotland. There's quite a few different ports that are having an impact. But I can't see it changing significantly. The vessel schedules, they are set in stone for probably a good 6 months in advance. So I don't think that's going to happen straight away.
And a question to thanks, Adam. A question to Janet, which I guess is around recovery. So I think as of today, the FTSE market is 6,500 and let's have a look.
6,564
right.
at the moment.
There's a couple of questions, which is that does seem to be priced quite high in comparison to the underlying value, which is you look at the situation with the pandemic and wages have not increased, unemployment has gone higher. So the assets seem to be higher than the underlying value. And I guess, will there be a correction in the market, or do you think, are people looking very much to the future? Well, how is the market priced? We'll come back to Janet. I think she just cut out. So I'll perhaps ask a different question to Jazz, which is, how do companies, and I guess you probably know the answer to this, how do companies protect themselves against the volatility of the pound?
Right, Jason, I think you've nailed it on the head there. I think that is the crucial point, and I will re-emphasize this. And if we have got the audience listening right now to this on air, we have actually had how many orders, not orders that have been executed, because nobody knows on Sunday whether there will be a deal or a no deal. Nobody's going to know if there's a no deal how much the pound's going to fall, or if there's a deal how much the pound's going to appreciate. But we have got a tool that doesn't cost anything, and this is literally 98% of our clients, since probably over the last sort of 7 days, as we're getting now closer. Since yesterday, we thought, Boris Johnson having his lovely little dinner there, of course we may have had that answer, but obviously not. So this Sunday, what we've done now, hopefully we're anticipating that there will, sorry, I think I just keep getting these pop-up messages, private chat. So this week, Sunday, we're hopefully, we should have the answer. But the key to your question, Jason, is something called a stop loss. Okay, what a stop loss is, and I will clearly explain this. A stop loss basically enables you to set a worst case exchange rate in the market, a worst case. Now, this triggers when the market drops to undesirable levels to protect you against any continuing to fall. So let me give you a bit of an example on that. Now, let's have a look at the euro rate. Let's just call it the pound euro is at 110 for argument's sake, okay? Because the currency exchange moves every increment of a second. Now, we're going to use 110 GBP euro. Now, if we've got an importing client, the fall in the pound, which could be anything between range bound, could be anything 5+%. Now, I'm sure an importing client wouldn't want to see a 5% drop against their P&L, their budget rate. So what a client can do here, if the euro's at 110, they could set the worst case rate at maybe 109. So for argument's sake, on Sunday, this Sunday, the 13th of December, when the markets open at 10 p.m, if there isn't an announcement, and the announcement is a no deal, the pound will just tumble. That 110 may become potential 102, 103. Who knows? We don't have the answer. But if the client left a worst case rate at 109, where today's market is 110, will automatically execute that rate 24/7. So that could be at 3 o'clock in the morning, could be any time. So rather than the rate, so no deal and the rate becomes 103, the client's probably only lost 1% from where today's market is at 110 and setting the worst case rate at 109. So they've really actually gained, if the rate ends up being 103, they've ended up saving themselves 6%. So I would re-emphasize, it doesn't cost anything for a client to place a stop loss in the market. There's enable a client to protect, just a moment there, and just to finish off.
Yeah.
Enable a client to protect their profits at no cost. And this is what 98% of our clients have done so far, importer or an exporter.
So people could definitely use that as a strategy alongside mitigating the risks of Brexit. What I'll do, Jazz, is I'll circulate your contact details to some of the exporters after this video, because if they haven't already contacted you, I think that's a good idea.
And also, Jason, just another point, we have got what's the opposite to a stop loss. We have got a limit order. So it doesn't cost anything to place these tools. So again, let's just use the example. Today's pound-euro rate's at 110. Now, again, this is an example of an importer. Now, if there's a deal, the pound appreciates. And as Janet mentioned, we are anticipating, hopefully, there's a deal on the back of something. And as we are anticipating a deal, market's already priced in. So therefore, the pound's not going to move as much as the pound's going to devalue on the back of a no deal. So what a client can do, based on the deal, they can leave the opposite to a stop loss. So if the market's at 110 and there's a deal, the pound potentially from 110 can become a 112, 113, 14. So they can also nominate a figure that's not already in the market now that we can actually capitalize on their behalf. So there's a stop loss and a limit order. But what I would re-emphasize, use a stop loss just to protect yourselves, rather than regret the following day thinking that we should have placed a stop loss. Thank you, Jason. Cheers,
Jazz. Can you put yourself on mute as well when that's the next question? I think there's a slight echo coming from your computer. It's only a very slight one, but just to make the quality a bit cleaner. Thanks for rejoining us, Janet. How's the sound?
Sorry again. Sorry again. I'm really sorry. I hope this will continue to run smoothly.
Yeah, brilliant. Thanks very much. So the question was around the FTSE market, which is this sort of decoupling of value versus the underlying asset. So how is the market pricing this, and what do you think the expectations are going forward?
To be honest, I think the UK stock market is, especially the FTSE 100, is really internationally focused. Even for the FTSE 250, a large percentage of revenue is derived from overseas. So I think right now, or at least throughout this year, I think the economic perspective definitely takes dominance. And I think, of course, right now we're shifting more focus into Brexit. But I think take the FTSE 100 as an example. We think that in case of a deal, as I mentioned, I think the room for further strengthening in the pound is a bit limited because a lot of optimism is priced already. So usually when you have that strengthening in sterling, the FTSE 100 tends to underperform because we just have so much international exposure. When you have stronger sterling, then your overseas earnings got translated into fewer pounds. But in this situation, we think the deal would be a support for the FTSE 100 market, for instance, because that is just really good news. Market like good news like that. So in the case of a no-deal Brexit, so it is a little bit tricky. I think initial market reaction could be a negative one, just like what we had back in 2016 when we had the referendum. So the knee-jerk reaction, I suspect, will be a bit negative. But then I think market will come to the realization that we will have an adjustment of the pound to a much weaker level from here. As I mentioned, there is a lot more scope to fall for the pound. But then it actually benefits the FTSE 100 in that way. As we have seen over the past couple of years, a weak sterling is good for the FTSE 100. So I kind of think whatever way you look at it, I think there is actually scope for the FTSE 100 to improve from here. And of course, you mentioned the value of the stocks. Basically, I think economic outlook is still paramount. So what we look for is more optimism next year for recovery, especially in the sectors that are heavily impacted by the virus, like the energy, the financial sector, the travel, which the UK sector is quite heavily exposed to. So there's another reason why we think the FTSE 100 they should continue to recover well into next year because of the control of COVID.
And I guess the FTSE market doesn't have as many tech companies as the American market, and maybe that would explain partly why the numbers aren't.
Yeah. This year definitely. FTSE only have, I think, less than 5% of technology exposure, whereas the US market is over 30%. The big 5 tech companies alone in the US is 25%, and obviously they have done super well in this pandemic. But I think there is a case for the UK to do better next year once we have the effective immunity from the vaccine.
Brilliant. Thanks, Janet. Just moving over to Adam. So obviously we've got this sort of supply chain problem at the ports. People don't really know what's going on. And what do you think companies can do to avoid congestion after the 31st of December?
Well, one of the things that we've been exploring with some of our clients at the moment, I mean, Christmas is always a busy period anyway, Jason. People trying to move goods before the end of the year. And then we have the Chinese New Year as well, which falls in February. So those 2 periods are very busy for cargo, regardless. And the coronavirus pandemic has just made it a lot worse for most people. But we're looking at other ports that we can bring cargo into. So rather than going to Felixstowe and Southampton, which are the main ports of the UK, we've been looking to see if we can move it into Immingham or into Liverpool instead. So there are other options that importers can request when they're speaking to their suppliers to see if they can do that. We might find that there are slightly longer transit time, but it means that it's not going to get held up in a long queue for a couple of weeks. So that's certainly one thing to consider. One of the things that I'd probably mention as well is that with there are quite a few changes that are coming in the new year, and importers need to make sure that they have or they are taking advantage of them. So postponed VAT accounting is one of them. It's free of charge to do. What that essentially means, it's not just for shipments coming in from Europe, it's from the rest of the world as well. At the moment, any import that arrives into the country, the import VAT, which is usually the larger chunk rather than the customs duty, it all has to be paid up front before it can be delivered to the final address in the UK. Now, there is a system called a deferment account where you can effectively put it on your tab and it'll still get cleared and you get invoiced from HMRC later on. However, they've allowed us to operate this PVA, postponed VAT accounting, and effectively it means that you don't pay the VAT up front and it just gets charged to your account with HMRC, so it'll hit your VAT return. So that's quite big from a cash flow perspective. So companies really need to make sure that they are asking their customs brokers about that. If they don't have their own deferment account, they're also likely being charged a fee for the use of deferment. So if there's a large chunk of VAT on there, again, there's an option there's quite a large amount of money that might be able to be saved, which again is quite important. One of the other things, Jason, that I'd quite like to mention is with the UK leaving the EU, it might allow for a few more customs procedures to be utilised, which will benefit businesses in the UK. So the typical scenario at the moment might be somebody in the UK importing raw materials from the Far East. They pay customs duty and VAT when it arrives into the UK. They then have customers in the EU, which they distribute to. And at the moment, there's no duty payable on those items because we're all part of the customs union. From the 1st of January, that's going to change. So what will happen is that goods from the Far East will continue to come into the UK, customs duty and tax payable. You're also then, if you've got customers in Europe, going to have to pay customs duty and tax in that country in the EU. There is a process called inward processing relief, which a lot of companies in the UK probably need to be aware of. What that effectively means is that when you're bringing goods in from the Far East, you're going to process them a little bit, tweak them before you sell them on to your clients in Europe. You don't pay any customs duty and tax when it arrives into the UK. There's only one hit. Now, that's not something that you can just declare on a customs entry. There's an authorization from HMRC that you can apply for. But again, there's quite a few businesses that we've been speaking to that will fall into that category, and that the process of obtaining the authorization might take 4 or 6 weeks to get in place, but it's certainly something that should be considered.
Brilliant, thanks, Adam. You made 2 good points there. So the VAT deferral system, I wasn't aware of that, and also the inward processing relief option. So I think that's a big boost for companies, importers and exporters. I'm sure that'd be much appreciated advice. What do you? I'll sort of digress a little bit, but how do you think the freedom of movement will affect supply chains? Perhaps this is a question for everybody. So obviously, as part of the reason for leaving the EU, perhaps freedom of movement was one of the deciding factors in the referendum. But obviously, we do benefit from that as well as a country, and certainly our companies. What do you think the threats are on that front?
Well, one of the issues that we've kind of been made aware of is through the inclusion in the EU, the number of kind of UK drivers. We all have kind of allocations as to how many nationals are allowed in each country to drive around on the roads, and there's been rumours of kind of numbers which are significantly less for UK drivers in European countries than what they currently are. So that is something which again, businesses will need to be aware of, and it could harm trade. So it'll be something which I'm sure an agreement will be made on, but that is something that we're closely monitoring at the moment.
Same question to you, Janet. So how is it affecting their reputation abroad? What are people, how is it affecting confidence?
Yeah, so basically, well, Brexit as a whole, well, we looked at the latest Bank of England's agents survey, which is published in December. So they surveyed many businesses across the UK, and they list that confidence hit is the biggest concern post-Brexit. So this is something, quite vague. It's not, I mean, of course, the border control, the more red tapes, the compliance, custom checks, of course, they are concerned, but the number one concern is confidence. And, this is really hard to control. And I think, your point about the freedom of movement of people, I think from an economic perspective, it has got bound to reduce long-term potential GDP for the UK. Because unless you can boost productivity meaningfully, well, your long-term potential GDP is basically a function of how much labor force you have in the economy and your productivity. And so far, the UK has been stuck in a very low growth in productivity for the past decade, really. There hasn't really been much, momentum. And I think with the restriction of the freedom of movement of people, we know how many workers, especially in the say hospitality, retail sector, and even in the financial services sector, a lot of these actually come from the EU. So that could potentially reduce that size of the workforce, which directly would lower the long-term potential of the economy. And of course, once you have that fewer pool of labor, that could potentially lead to higher wage growth as well, where you find it harder for to get the right people, basically. So that will push up wages, and that will just mean higher cost for businesses, which is not great in the long term.
Yeah, it's a good point. I think the productivity puzzle has been, it's not just a UK problem, of course, it's a global problem, particularly in Europe, where you've got some sort of stagnation in terms of productivity, and maybe we've maximised the amount of productivity we can actually get from people. And the next phase will probably be automation, artificial intelligence, and maybe better use of technology.
Yeah.
Which, as a country, we're probably not as far forward as we should be. Yeah, that's something to work on. How about you, Jazz? How do you think the freedom of movement is going to affect us going forward? Do you think it's positive or negative?
God, it's a good question. I think again, highly kind of dependent on Sunday, really. I think hopefully if there is a deal or no deal, I think Adam's already kind of and Janet's more emphasised on a lot of the points I would have mentioned. But I think again, if there's that no deal on the Sunday, of course. I mean, today, what did we announce today? I've got a bit of a, here we are, just a bit of a point here. Today there was a released figure figures show that the economy grew by 0.4% today versus a previous reading of 1.1%. So, I mean, if there's a no deal, we know the devaluation of the pounds, of course, going to affect GDP, and the actual the hypothesized emphasis based on the no deal devaluation of the pound would obviously could have a potential drop in the GDP by 2%. And of course, as we all know, as we see a loss in the GDP, unemployment rate rises, of course, because of manufacturing, international trade, or import more manufacturing. Of course, we know GDP, and that obviously we know the knock-on effects back in 2007 and 8 when we had that when we had the recession. We know the sequences when the unemployment rate rises, we see a crash on the housing market as well. So I personally think we potentially could there could be a negative confidence personally back of a no deal because of GDP factors of high increasing unemployment rate rising. It's going to, of course, have knock-on effects on the housing market and people not either way, because we know that the furlough scheme comes to end in March 2021, and who knows what's going to happen to that? Will there be another extension? It's a bit like what if there isn't a deal or a no deal on Sunday? Will there be an extension?
I think there's an interesting philosophical point to this. So I think in the West we're going through a process of massive change, and you can see it obviously in the US, you can see it in the UK, maybe in some of the other European countries as well. And we did a project some time ago called Made Equal, which is an equalities campaign. And this is really a consequence, I believe, of we're not actually in harmony with each other. So one of the threats that we've got as a society is we've got a portion of society that feel that they're not included. So they've kicked back, protested, and for whatever reason they're not on the housing ladder, they're not participating necessarily, or they feel that society is not treating them fairly. And it's those people that really have sort of driven, the Trumpism and perhaps even the Brexit discussion. So perhaps there needs to be a wider discussion about what the other side of Brexit looks like, how it can fix some of these problems. Because if you get an inequality divide that becomes too big, that is a threat to society. So how do we ensure that the recovery is more inclusive so that people don't get left behind and we can have a more harmonious society? Because if we have civil unrest, it actually puts the whole system at risk, doesn't it? We're in an ecosystem, we also depend on each other. I mean, perhaps that's something you might want to have an input in, Janet. I know it's not necessarily financial data, but it is quite an interesting sort of analogy in terms of how these sort of financial gaps appear and how we can maybe solve some of those problems.
Yeah, absolutely. Basically, I have been doing outlook presentation for next year, and I put one of the risk as inequality is one of the risk, because we already see this year that this recovery is highly uneven, where some people actually benefited significantly. The tech sector was doing well, people who work from home able to sit at home comfortably, where some people just suffered disproportionately. So going into next year, the growth would be better, but still there will be some permanent scarring in the economy, which would affect those people more disproportionately. And that would have implications on the national output as well. So I think it is very, very important to actually retrain those people who lost their job permanently. It is because sometimes it is not through their own fault that the structure of the economy is changing in the next direction. And unfortunately, the pandemic actually accelerate those changes. So maybe those jobs are bound to be lost in the next 10 years. But suddenly, the heat of the pandemic means the job disappeared overnight, right? So this is something that is very hard to manage on an individual basis, and is really, really up to the government to help to retrain these people, or corporates actually have a corporate responsibility to kind of help these people to retrain or have them on board and offer apprenticeship, etc. So I think this year the government has thrown money at every single issue, but I think next year it's got to be much more targeted in terms of the fiscal support. whether it's the UK, US, they got to help the people most in need, because in the long term, it's going to be quite, a time-ticking bomb, as you mentioned, potential social unrest, and inequality is just not great for any government to stomach.
Thanks, Jenny. Great answer. Adam, I just want to come to you next, because obviously you're based in Yorkshire, and at the start of the election cycle, Boris Johnson talked about levelling up, and we know that the North has been harder hit, and obviously we've got these fractions. That's what this pandemic has done, is put pressure on society, and maybe the fissures that were already there have just been exposed. What do you think we can do to actually fulfil those goals? So to level up in the North, what needs to happen?
It's really tough. I mean, I do speak to quite a few people from here that are always mentioning to me about the HS2 investment that now looks like it's going to be curtailed, so it's not coming up to Leeds anymore, perhaps, or certainly been delayed. And similarly with even things like the closure of hospitality and Leeds being in a tier 3, whereas most parts of London, which it looks like have a higher R rate than our region. There is people that do see a north-south divide kind of increasingly appear, and it's going to be really difficult for the government to make sure that they do kind of respect that there is that kind of division there at the moment, and do what they can to ensure that it is a smooth one country, one nation. We have Scotland, who are quite keen, by the looks of it, to try and have another discussion on their own independence. The mayor system, it looks like in the regions, with from leaked documents, it sounds like the government aren't too keen on that either. So it is tough. We do feel, from speaking to people, that the North is maybe getting a slightly raw deal. And it's going to be difficult for the government to make sure that they don't get left behind. How they can do that from a logistics point of view, we've looked at things like a free port option, so that there's certain areas where we can try and maybe in the underused areas that used to be in industrialist parts of the country in the past. Like Middlesbrough's been talked about as a place where we could create a new free port. So take some of the stress away from down south. Not all the shipments that we have coming into the UK end up down in the south. In fact, a lot of them do end up in the north. And they could maybe benefit from putting a bit of investment into infrastructure there, so that we have a port up there, create new jobs, get the economy going in some cities and towns which have kind of had fallen on like worse times, if you like.
Good idea, Adam. And obviously, if you look in history, whenever there's major infrastructure investment in ports or travel destinations, you get an increase in economic output. So it would be a great opportunity to perhaps build on infrastructure, create some jobs, and level out the UK so that the North, like you say, doesn't get left behind. How about you, Jazz? What are your fears and hopes in regards to the sort of the harmony question, which is this civil unrest, which we can't ignore that, because it's plainly visible. How do we address these problems so that we don't implode as a country or even as a continent?
I think most of the questions, of course, Janet's probably answered there, and Adam. I think it's a difficult one to answer at the moment. I think again, most of the points Adam and Janet have actually answered the question, really. Yeah.
Thanks, Jazz. I'd just like to thank everybody for participating in today's discussion. Is there any questions or anything that you'd like to mention that perhaps I haven't asked? Any final thoughts, Adam?
Final thoughts. I guess so. From a logistics point of view, kind of what I do day in, day out, there will be changes. We'll get through it. I'm sure we will, regardless of what the outcome is. We'd like to see a deal forged, but there'll be teething problems. But we'll look back probably in 12 months' time and we'll have the new norm with regards to trading with the EU, whatever that might be. Fingers crossed. And we're quite a good bunch, really, in the UK, and I think that we'll change and we'll adapt to make sure that we do come out a bit stronger. And going to your point previously about people maybe kind of a division appearing or cracks, I think maybe the EU breaking away might bring the UK closer together, maybe as a community as well, which will be interesting to see, because it'll almost be an us against them kind of mentality. So it might actually have a positive effect from that respect when you're looking at that division. So I think we've just got to remain positive, and we'll get through any kind of change. We've done it in the past, and I'm sure we'll do it again this time around.
Brilliant. Thanks, Adam. Very optimistic. I like it. Jazz, any final thoughts?
I think, leaving it kind of on a positive note, again, this morning we've continued on a post-Brexit deal outside of the EU. So I don't know if anybody knows that this morning the UK have actually signed a deal with Singapore that's worth more than just over 22 billion in trade. So we've got to look at, it's a large deal, that mirrors agreement already in place between Singapore and the EU. So I think, even if we do kind of leave without a deal, we have got already kind of a contingency options to work with the likes of Japan, Canada, or we've already got other plans already in case we do on the no deal. So I think, being optimistic, I think there's a lot of opportunity on the back if there's a no deal. But of course, hopefully let's keep our fingers crossed, and hopefully there is that deal in place that'll keep everything in line. Of course, ourselves with the EU, as we all know that comments raised by the States. Biden's a big fan of the EU, and there's a lot of alliance with the States and the EU, and he's hoping that we can actually put the two jigsaw pieces together with a deal on Sunday, hopefully. But what I would really emphasise, myself being a qualified strategist in foreign exchange, currency market, I just hope clients don't make that same mistake that a lot of them did soon as there was that post referendum announcement the following day, that they didn't put any protection safeguards in the market. Because I've seen a lot of firms the following day when we know the announcement of the referendum, how many clients went into liquidation, administration. But a lot of them could have been in a safe haven where, if they had possibly used simple vanilla tools like stop losses, just leave it in the market. It doesn't cost anything. It'll save you, if there's a no deal, it'll save you against maybe if the pound drops from 110 to 103, it'll save you supposedly 7%. And you may, what's more better? Is it best to lose 1%? And keeping your industry still, your business still running, and keeping everybody employed. So for me, I would say, guys, please, I wouldn't emphasize this anymore. At least just have protection that doesn't cost anything. It doesn't cost anything at all. So that's as much as I can say for today, Jason.
Yeah. Thanks, Jazz, and thanks for joining us. I agree, it's great news that we've got a deal with Singapore. Obviously, we've built up some good relations there. We've got obviously Singapore, Japan, and hopefully many more. I'll share some of Adam's optimism. Sometimes you can see the best in people when they face the toughest of challenges. And I'd just like to finish with Janet. Any final thoughts from you?
Yes, I also would like to end on a note of optimism. I think, the COVID-19 pandemic, a lot of people struggled, and we have seen unprecedented disruption to supply chains. And after all, people adapt, and we have proved to be more resilient than we have been. So same for Brexit. I mean, we don't know whether there will be a deal or not, but I think, relative to, say, March 2019, I think businesses are much more prepared at this moment than a year ago or so. So at least there is hope that things wouldn't be as bad as people have feared. And I think post-Brexit, there are still a lot of things that the UK can work on. For example, I think the trade deals are absolutely very encouraging news. In fact, actually, throughout this period, the UK has already kind of negotiate trade deals with those countries that we originally had a trade deal with the EU. So good progress on that. And we've also got the trade deal with Japan and most recently Singapore. And there's just so many areas to look at, because basically, if you look at global trade, Asia is a thriving region. They just signed the biggest trade deal in the world, RCEP. You know, the UK, basically, we export less to, I mean, we export more to Ireland than to China. China is the second largest economy in the world, gonna, you know, project to be the largest in 2030. So there is actually huge opportunity out there than your neighbors. So I think, you know, lots to work on, lots to look forward to, and of course, as Jason has mentioned, there is still a lot of scope for UK to improve its productivity by investing in the right areas, like, you know, the tech infrastructure and the green energy infrastructure as well. So I think, well, there is a lot of hope still for us post-Brexit, deal or no deal.
Fantastic. Well put, Janet. So I just leaving to say thank you very much for joining us, and thanks for being our first panel discussion on Made Live TV. Really appreciate you giving up your time to you know, to speak with me and to you know, help our members navigate the challenges of Brexit. Thanks very much.
Thank you.
No problem.
Bye.
Thank you.
Thank you.